This is an Uncovered Japan Company research report on Comsys Holdings, ticker 1721. Comsys builds and maintains telecom networks, data centers, IT systems, and social infrastructure across Japan. In this video, we will look at how that operating model works, what the financial record shows, and the questions the current valuation leaves open. The quick snapshot is a quality contractor with a forward price-to-earnings ratio of 16.2 times, an 8.1% operating margin in fiscal 2026, and a 70.7% equity ratio. Management's total payout target is about 70%. Those figures explain why the shares are not priced like a distressed construction name. The key issue is whether the data center, IT, and social infrastructure opportunity can deliver enough growth and margin to support that quality valuation. This is what the company does in practical terms. Comsys began in telecom construction, where it builds and maintains network infrastructure. That foundation now sits alongside data center systems, IT solutions, transport and civil infrastructure, and renewable energy work. The report describes a nationwide group structure that gives Comsys reach across these activities. It is not a single project contractor. It is an infrastructure operator whose know-how is being applied beyond the traditional telecom base. Revenue reached 630.7 billion yen in fiscal 2026. Over the 5 years shown, revenue grew at only 1.7% annually, while operating profit grew at 4.3%. The difference is important. Comsys is not relying on rapid top-line expansion. Its financial improvement has come from recovering margins after the fiscal 2023 trough and from earning more efficiently across the existing operating base. The segment mix explains both Comsys's resilience and its next challenge. Telecom carrier is the largest revenue stream and has the strongest displayed margin. IT solutions has a second source of earnings. Social infrastructure is already a third of revenue, but its displayed margin is lower. The strategic opportunity is to grow data center and social infrastructure work without allowing the mix shift to dilute the group margin that makes Comsys stand out among its peers. Comsys's moat is built from operating capability rather than a consumer brand. The report points to a 5-decade NTT relationship and a nationwide network of 8 operating companies. That experience is difficult for a new entrant to reproduce quickly, and it can be reused in data center, IT, and public infrastructure work. But the same relationship is also a risk. The report estimates that around 38% of orders depend on NTT, so carrier capital spending remains the master variable to watch. Comsys has a fortress-like balance sheet. The fiscal 2026 equity ratio was 70.7%, and the report describes the company as effectively debt-free. Return on equity has recovered toward 9% after the fiscal 2023 dip, but the large equity base also limits how high that return can go. That makes capital allocation more than a footnote. Dividends, buybacks, and the use of surplus capital all matter to the investment case. Cash flow moves around with working capital, which is normal for a project-based contractor. In fiscal 2026, operating cash flow was 42.5 billion yen, and free cash flow was 26.8 billion. The report estimates average free cash flow of roughly 22 billion yen over 5 years. The relevant question is not whether every year is smooth, it is whether the cash generation remains sufficient to fund the progressive dividend, buybacks, and investment in the higher growth parts of the business. The Group Vision 2030 puts a clear number on the strategic ambition, 800 billion yen of revenue by fiscal 2030, with a 1 trillion yen aspiration beyond that. The report identifies data centers, IOWN, and 6G, national resilience, and public sector digitalization as important tailwinds. Achieving the target means accelerating from the low-growth telecom base while preserving profitability. The evidence to watch is order intake and margins, especially in the social infrastructure business. 16.2 times forward earnings is not extreme in isolation, but it is above Comsys's own 5-year average of about 13.2 times. The report connects that re-rating to stronger margins, a progressive dividend and payout policy, share cancellation, and the data center theme. This means the valuation debate is less about whether Comsys is a quality company and more about whether future earnings and capital returns can validate the higher multiple already paid today. This scenario chart is an assumption test, not investment advice. The report's 3-year base case suggests roughly 8% price upside, plus a dividend yield of about 2.5%. The bear case is much lower if carrier capital expenditure weakens and the operating margin rolls back. That range keeps the focus on the practical indicators. NTT-related orders, backlog, the social infrastructure margin, and evidence that data center growth is translating into profitable work. To wrap up, Comsys is Japan's most profitable telecom construction major, supported by a national operating network, a strong balance sheet, and clear exposure to data center, IT, and infrastructure investment. The report also makes the trade-offs clear: meaningful NTT dependence, a lower margin mix shift to manage, and a share price that already reflects much of the quality. For the full evidence, assumptions, and source detail, continue with Uncover Japan's free deep dives. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.